Today, we will talk about elasticity in finance. Elasticity is a measure of a variable's sensitivity to change in other variables, such as price. Its concept plays a crucial role in economics and business, and understanding it is essential for consumers and businesses alike. Elasticity measures how sensitive a variable is to changes in other variables, such as price. In economics, price elasticity is the degree to which demand changes in response to price changes. If the value of elasticity is greater than 1, demand is more than proportionally affected by price changes. If elasticity is less than 1, demand is relatively insensitive to price. If elasticity equals 0, it is said to be perfectly inelastic, meaning demand remains unchanged at any price. Elasticity is an economic concept used to measure how the quantity demanded of a good changes in response to price movements. A product is considered to be elastic if the quantity demanded changes more than proportionally when its price increases or decreases. A product is considered to be inelastic if the quantity demand changes very little when its price fluctuates. For example, insulin is a product that is highly inelastic because price increases have very little effect on the quantity demanded. The quantity demanded of a good or service depends on multiple factors, such as price, income, and preference. Price elasticity of demand measures the sensitivity of demand relative to a change in price. Income elasticity of demand refers to the sensitivity of the quantity demanded for a good to a change in real income of consumers. This helps classify goods as necessities or luxuries. Cross-elasticity measures the responsiveness in the quantity demanded of one good when the price for another good changes. It helps understand the relationship between different goods. Price elasticity of supply measures the responsiveness to the supply of a good or service after a change in its market price. Typically, the supply of a good will increase when its price rises. The more good substitutes there are, the more elastic the demand will be. For example, if the price of a cup of coffee increases, consumers might replace it with tea. However, if the price of caffeine itself were to go up, there may be few good substitutes, making it an inelastic product. Goods that are needed for survival or comfort are less affected by price changes. For example, people will continue to pay higher prices for gasoline even if the price doubles or triples. The influence of time on elasticity is significant. For instance, cigarettes may be inelastic in the short run for someone with a nicotine addiction, but become elastic in the long run if the increase in price prompts them to kick the habit. Understanding the elasticity of a business's goods or services is crucial for its success. Businesses with highly elastic products compete on price and rely on high sales volumes. Inelastic products represent must-haves and allow for higher prices. Real-world examples of elasticity include Uber's surge pricing, the COVID-19 pandemic's impact on various industries, and the historic drop in global demand for oil in 2020. Elasticity measures the responsiveness of quantity demanded or quantity supplied to one of its determinants. Elastic goods see their demand respond rapidly to changes in factors like price. Inelastic goods retain their demand even when prices rise sharply. Luxury goods often have a high price elasticity of demand because they are sensitive to price changes. When prices rise, people quickly stop buying them and wait for prices to drop. The four types of elasticity are demand elasticity, income elasticity, cross-elasticity, and price elasticity. Price elasticity measures how much the supply or demand of a product changes based on a given change in price. The elasticity of demand can be calculated by dividing the percentage change in the quantity demanded of a good or service by the percentage change in price. Here are 3 key takeaways. 1. Elasticity measures the sensitivity of one economic factor is to changes in another, such as supply or demand to changes in price. 2. If demand for a good or service is relatively static even when the price changes, demand is said to be inelastic, and its coefficient of elasticity is less than 1.0. 3. Cross-elasticity measures the change in demand for one good given price changes in a different, related good. Hope this would help. Thanks for watching.